Welcome back to the Risk Manager's Corner. Today's episode peels back the curtain on Lloyd's of London, not a company, but a one-of-a-kind insurance marketplace that's been central to global risk transfer for over 3 centuries. We're covering how Lloyd's began and evolved, its unique structure, syndicates, managing agents, members, brokers, and cover holders, how capital is organized and secured, what makes it so powerful in catastrophe and specialty insurance, and why risk professionals around the world should understand it. Let's dive in. 1. Lloyd's beginnings and evolution. Lloyd's started in 1688 in a small London coffee house. Merchants, shipowners, and underwriters gathered to share shipping news and place insurance on maritime voyages. This was the birth of underwriting, people literally signing their names under descriptions of the risk they were willing to take. From those early marine policies, Lloyd's evolved into a global insurance marketplace that now covers everything from cyber attacks and satellites to political violence and pandemics. 2. What Lloyd's is and isn't. Let's clear something up. Lloyd's is not an insurance company. It's a regulated marketplace, a corporate body created by law. It doesn't write insurance policies itself. Instead, it facilitates a platform where risk is underwritten by independent groups known as syndicates. These syndicates are supported by managing agents who run the syndicates, members who provide capital, brokers who bring business into the market, and cover holders who write risk under delegated authority. 3. How the market works. Here's how the Lloyd's model flows. A broker approaches the market with a risk, say, insuring an airport, a wind farm, or a luxury yacht fleet. That risk is reviewed by underwriters in various syndicates. Each syndicate may take a portion of the risk. The total coverage might be spread across 5 or 10 syndicates. Managing agents oversee syndicates, hire the underwriters, and ensure operational compliance, claims handling, and reinsurance placement. Cover holders act as delegated underwriters outside London, extending Lloyd's reach to local markets globally. 4. Capital structure and chain of security. So, how is all of this backed financially? Capital comes from members. These can be individuals or corporations like banks, pension funds, and insurers. The Lloyd's capital model is based on a 3-tiered chain of security. 1. Syndicate assets held per underwriting year. 2. Funds at Lloyd's, provided by members and held in trust. 3. The central fund, a mutual reserve used if all else fails. This layered structure ensures that if a syndicate experiences a shortfall, policyholders are still paid. 5. Size, specialties, and global reach. Today, Lloyd's includes dozens of syndicates managed by multiple agencies, writing over £50 billion in annual premium. Its specialties include natural catastrophe reinsurance, cyber risk, aviation and space, political and trade credit, terrorism and war, niche and hard-to-place commercial risks. Lloyd's licenses allow it to write business in over 200 territories globally. It's the go-to market for complex, international, or high-risk exposures. 6. Regulatory oversight and governance. Lloyd's operates under a unique legal framework and is regulated by UK authorities. All syndicates must meet strict criteria: business plans, capital adequacy, reinsurance structure, risk governance protocols. Managing agents are accountable for compliance, risk culture, and performance. Annual audits, actuarial reviews, and reinsurance stress tests are mandatory. This governance model ensures standardization while preserving underwriting independence. 7. Strengths and limitations. Lloyd's unique strengths include risk diversification across syndicates, capital efficiency through pooled support, unmatched global licensing footprint, talent density in specialty lines. But it's not without challenges. Multiple syndicates on one risk can create correlation exposure. Centralized losses, like 9/11 or a natural disaster, can hit many parts of the market simultaneously. Its complexity can also create friction in claims handling, system integration, and regulatory alignment. Still, Lloyd's has consistently paid even the largest claims, preserving its credibility and global role. 8. Innovation and modernization. In recent years, Lloyd's has focused heavily on modernization. Initiatives like Blueprint 2 aim to digitize and streamline the market. Faster placement, improved data, and better claims efficiency. New syndicates are experimenting with parametric cover, insurtech platforms, and climate risk models. Lloyd's is also increasing scrutiny on ESG performance, sustainability, and diversity across managing agents. Its ability to balance legacy and innovation is what keeps it globally relevant. 9. Why Lloyd's matters for risk managers. If your institution holds a policy backed by a Lloyd's syndicate, you are tied into this structure. As a risk manager, that means you must understand syndicate-level counterparty exposure, monitor systemic risk from large losses, assess the capital quality behind your coverage, factor Lloyd's correlation into reinsurance, investment, and accumulation models. Lloyd's isn't just a brand, it's a risk architecture, and knowing how it works helps you defend your portfolio better. Final takeaway. Lloyd's of London is more than history. It's one of the most sophisticated, resilient insurance platforms in the world. Its structure is complex, its model is unique, but its impact is global. Whether you're buying capacity, pricing risk, or reviewing treaties, understanding Lloyd's is essential to serious insurance risk management. In the next and final episode of this series, we'll unpack emerging insurance risks and synthesize everything we've covered in one strategic blueprint. Subscribe and stay sharp. We're closing strong.